joining us once again here at Seaford and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to look at the results for the third quarter of the Community Bank Benchmark Group. And this group consists of banks with assets between $100 million and $5 billion as of the first quarter of 2017. So overall, the aggregated net income for this group increased by 6.2% quarter over quarter, and we're at $5.9 billion for this group here on an aggregate level, up from the second quarter net income of $5.5 billion. So overall, the income has increased by that 6.2%. That's very important as we go into the overall return on average assets. And we can see, looking back to last year, 2016 Q3, we were just at that 1% mark. We dropped down in the fourth quarter of 2016 to 92 basis points. And then we've been on this upward trend since then. 94 basis points in the first quarter, 101 basis points in the second quarter. And here we are today at that 106 basis points, or a 1.06% of average assets. So overall, as a benchmark group, continuing to see an upward momentum of these returns. We look at the sub-benchmark groups, and what we do here is we break the overall Community Bank Benchmark Group into three subs. We have the group that classifies themselves as subchapter S, and then we have the stock performing group, and then we have the mutual institutions. And overall, we see similar trends in here, but obviously they're at different levels. The mutual group, totally different business model, and you can see their average or their median return for the third quarter is at 58 basis points, up from where we were last year in here. Now we look at the stock group here, and they're at 95 basis points. Again, up from where we were last year at 88 basis points. And then we have the subchapter S group, and they're at that 146 in here. Remember, they're not reporting any taxes on the federal level at those institutions, so that's why they're so much higher. And that's why we like to separate them out from the individual groups here. So they're at 146, up 6 basis points from where they were back in the third quarter of 2016. So we see a trend overall of upward momentum in earnings, and that's a positive. This trend has been led primarily by the overall net interest margin. We see this net interest margin pick up in here. We're at that for the third quarter 2017 at 3.83, up from where we were at 3.79. So it's up 4 basis points quarter over quarter. And then we're back here in 2016 at the 3.75. So we see this increase in net interest margin occurring because of two reasons. One would be the overall increase in the level of earning assets. And then, so we see this earning assets increase to 4.21% in the third quarter, up from where we hit this low here over the past 5 quarters of 4.03. So we see this continual increase. This is a combination here of rates coming up a little bit, but also the mix of the assets kind of changing, where the loan portfolio has been growing faster than overall assets. And therefore, the loans to asset ratio have been increasing. And this has been a trend over the past several years. In fact, when we look at this more long-term trend going back to 2000 or 1998, we look at this longer-term trend and we can see recently just this continual uptick here beginning in 2012. Prior to that, we reached a high in 2008, at 70.83. So where we are today at 70.72, just under that high that we reached back in 2008. So we're starting to creep back up. This also as well comes at a cost, right? We get a benefit of the higher overall yielding earning assets, but our risk tends to increase during this time period. And we've seen the credit risk increase a little bit, and then we also have an increase in liquidity risk in here as we see this level of loans to assets continue to rise. When we look at the other side of the equation for net interest margin, we look at the cost of funds, relatively flat. We're at 50 basis points now, up just 6 basis points over the year and 4 basis points quarter over quarter. So we begin to see that tick up a little bit quarter over quarter. We haven't really seen the increase in the core deposit pricing as of yet. We continue to see the increase in cash type deposits, but we haven't seen that overall increase in pricing. On the time deposits, though, we were starting to see those specials. We continue to see those come out, and we continue to hear banks say that their CD customers are coming in and trying to renegotiate their pricing. So this is pushing up that cost of funds. When we look at the cash type deposit, the total deposit ratio, we're up from where we were last year and from the quarter before, but we've seemed to have kind of leveled out over the past several quarters. We're in that 72% mark. So it will be interesting as we move along in here throughout the rest of 2017 and into 2018 to see how these numbers start to react to the lack of repricing of these cash type deposits. That's what we have for you this week. We look forward to seeing you next week. We got a couple of numbers, economic numbers coming out that should set us up for some good discussion regarding the Fed and the probability of them increasing rates in December. So we look forward to seeing you next week. Have a great week, everyone.